Hello everyone. In today's video, we will cover the rest of the part that we haven't finished in the last video. In the last video, that we study about simple final accounts or final accounts without adjustments. This video is about final account with adjustments. That's also your learning outcome too, as I mentioned in the previous or in the first video, that in your learning outcome 2 you have two tasks, task 3 and task 4. Task 3 is about all the adjustments, and task 4 is complete final accounts with adjustments. So you're gonna explain the treatment of each adjustments in task 3, and in task 4, following that adjustments and trial balance, you're gonna complete your final accounts. All right? Or second options is you can combine task 3 and task 4, so you don't have to show me adjustments separately. You just complete the final accounts with the adjustments, and in the same same calculation you're gonna focus on the adjustment and their treatments. All right, so now I'm going to show you final account with adjustments. So what I'm going to do, I'm going to give you, I'm going to do 3 things in this video. Alright? Related to adjustments. In the first part, I will explain you what are the adjustments. Alright? Any kind of transactions that occur after preparing your trial balance. That's called adjustments. We're gonna make some adjustments. We're gonna adjust those transactions when we are preparing a final account. All right. So I'm going to explain you what these adjustments are, or what these transactions. What are these transactions? Right? What are these transactions that occur, more likely to occur after the trial balance? Right? And in second point, all these kinds of transactions, what are the journals entries? All right, whatever transaction we have, I think we have around 9 to 10 transaction or adjustments. We're gonna make it when we are preparing final accounts. So I'm gonna show you all the journal entries for those transactions, 10 transactions. That means, of course, you have 10 journal entries. All right, and the third one is a treatment or records. How we gonna records these transactions? Some in profit and loss, some in the balance sheet. So record in profit and loss and balance sheet. So that's the 3 things you're gonna learn in this final account with adjustments. First thing, what these adjustments are. Right. Second thing, what are the journal entries for those adjustments? And third one is how we records. If profit and loss, where? And if balance sheet, where? Or profit and loss, balance sheet both, but where? All right. So let's begin with the adjustments. So we give quick glance over the previous video that we studied. So in the previous video, we learned about what is final accounts, but it's a simple final account. It's a combination of profit and loss and the balance sheet. We also learned about the accounting cycles, right? But it's a simple means without adjustments, right? That's the previous one, right? How we prepare income statement, what inside the income statement, or what is the format of income statement, and we also studied about the balance sheet, what is the formats, it's vertical formats, and start with the total asset, which is current assets and non-current assets, and then total liabilities plus shareholders ownership or shareholders equity, which starts with the current liability, fixed liability, and at the end of the equity. So the idea is that total assets equals to total liability plus equity. That's the quick view over the previous video. Now, move on to the adjustment. So, why we have to make adjustments? The reason is this is completely unfair to provide it's completely unfair to provide unadjusted final accounts. Now, what does it mean, unadjusted final accounts? Unadjusted means incomplete final accounts, or the final accounts which is not providing true and the fair picture of the company financial records. Why not? Because of course we did not cover, or we did not make some changes in the final accounts as per the transaction occur after the trial balance. So, so we have source documents, as I explained, we have journals, we have T accounts, we have trial balance, and we have final accounts. All right? So, when we ignore any kinds of transactions which occur after trial balance, and then we prepare final accounts by ignoring all these kinds of transactions, that kind of accounts are non-adjusted, or that kind of accounts is providing unfair or not true and fair information to the users. So the main objective of final accounts with adjustment is to provide true and fair picture to the users of financial statement. That's why we have to do this. All right, we cannot ignore it. All right, and this is one of the requirements as per the accounting standard that makes sure financial statement is presently fair, or financial statement providing true and fair picture to the all kinds of users. True means real, fair means for everybody. Alright, so we are not hiding any things that may be important for some users to make financial decisions. Alright, that's the main ideas of the true and fair picture or view. That's why we have to do this, in order to ignore the unfair information. Okay. Now, what is that? What is this kind of adjustment? final accounts or any kinds of transactions that may create any kinds of complexity. What does it mean? It means that in the real world, not simple final accounts, in real worlds, transactions more likely to occur after trial balance, which creates some kinds of complexities in order to prepare financial accounts. What these complexities are? Complexities include accrual base. Accrual basis. So that's kind of accrual basis creates some kinds of complexities. Now what is accrual basis? I hope you study accounting principles, accounting concepts, or accounting conservatisms in your principle of accounting. If it's not, I'll give you quick ideas about accounting concepts, principles, or some kinds of conservatisms. Now, idea is that whenever we prepare financial records, we have to keep some kinds of things or some kind of standard in our mind when we are preparing financial records, such as I just explained about true and fair view. So make sure financial records is providing true and fair views to the users. Similar to true and fair, we have a going concern concepts. All right, we have a matching concepts. Among all these kinds of concepts, one of the important concepts is the accrual base, right? Accrual basis. So accounting is always done, or we prepare our financial accounts on the basis of these concepts, which is accrual base. Right? Now, what is accrual base? Accrual base means according to accrual base, income will be treated income when we earn it, not when we receive it. No matter when we receive. The important is earn it. So when you earn it, then you will record it, not you wait to receive it. So for example, today I sold my product, right? But when I sold my product on credit, which means I sold my product now, but customer will return me money maybe 1 week later. So what does it mean? I will receive money 1 week later, but I will not record 1 week later when customer will return money back to me. No, I will record the time I earn. I earn now or I earn next week. Of course, I earn now. So I will record now, all right, as a revenue, all right, or as an income. That's the meaning of accrual concepts or accrual base. The time of earning is important than the time of receiving. We will record the transaction at the time of earning, not at the time of receiving. All right. So of course, when we receive, of course, we will record the cash, but we will not receive. We will not only wait to receive to records. All right. We earn it, we record, and when we receive it, of course, some transaction also occur. So the time of earning is important. All right. Earn means you can say that right to receive. All right. You earn the right to receive something. So. And in expense, are incurred than paid. The time when expense incurred means the time expense arise, not the time we pay it. Alright? When expense arise, when expense incurred, we will record it. Alright? We do not wait to pay. Okay, now I'm paying, I'm recording now in my account, so of course not. Alright? So of course some transactions also occur at the time of payments, but the initial transaction will be occur on the basis of incurred, not on the basis of paid. Alright? Initial transactions. Same thing here. Initial transactions in terms of income will be record on the basis of earning, not on the basis of receiving. Keep in your mind. Alright? These kinds of concepts, it's called accrual base. So accounting is a accrual base. It's really important. Why important? Because let's say my balance date, or I prepare final accounts at the end of the period. So let's say 31st of December, right? Now what happened on 24th of December, I sold my product on credit, alright? And customer said he or she will return money back to me after 2 weeks, alright? After 2 weeks means, is it in January, alright? The first week of January. So January means next financial year started, because January to December, right? So transaction occur on 24th of December, but customer said he or she will return money back to me 2 weeks later. So 2 weeks later means new financial year started. So now the question is, when I sold my product, I should wait to receive, which will be next year, or I should record now in this year? Answer of this question is, of course, I will record now, because I earn money now. Alright? If I will not record now, of course, this year my income will be affected. Alright? As a result, my profit will be understated. Alright? So that's why it's really important. Same thing happened here. Expense incurred. This year expense incurred, but time to pay is 2 weeks later, but I will record now, not for the next year. Right? Because this belongs to this year. That's the ideas behind accrual base. Right? So keep it in mind. It's important to understand this sum of adjustments. Right? So that's the ideas behind the adjustments, a reason to make it, and how or on the basis of what we make our final accounts with adjustments. Right? So now move on to the first one. What these transactions are. Alright? So I'm going to write down some transaction here. So I will explain you these transactions side by side. Alright? So let's start with the first transaction, which is the closing stock. Now, what is the meaning of closing stocks? You know that closing stock is a stock which is left at the end of the period. So keep in your mind all these kinds of transactions occur after trial balance. Alright? Keep in your mind, we haven't record these transactions in our accounts. Alright? Keep in your mind this thing. Here. These. We ignore it. Means, of course, we haven't record here, here, and here. We haven't record transactions. Why? Because it's occurred after trial balance. Of course, that's why we haven't recorded. We haven't recorded these transactions. Right? So, what is the closing stock? Closing stock is the inventory which is left at the end of the period. That's called the closing stock. Alright? Now, what will be the journal entry for this closing stock? Right? So, closing stock, journal entry, and how we record, where we record in profit and loss, and where we record in our balance sheet. Right? So, what is the journal entry for closing stock? Journal entry, we're going to make it, of course, journal entry, and then we record using the T accounts or the trial balance. Or we don't have to do it, we just make journal entries in order to understand how we're going to make adjustments, and then we transfer in profit and loss on the balance sheet. Right? So, journal entry is debit, closing stock, alright, credit, profit and loss account. That would be journal entry for this closing stock. Alright. Now, what will be the treatment for, or how we record this journal entry in our profit and loss and balance sheet? Of course, it will be recorded in profit and loss account. Why? Because normally what we do when we are estimating our cost of goods sold, opening plus purchase less closing. Alright, less closing. So means when we are preparing our income statement, closing stock must be subtracted when we are estimating cost of goods sold. So profit and loss account. Alright, so I will write down here minus. Alright, so let's say example is a plus. Opening stock plus purchase and material labor so on minus closing stock. That will give you cost of goods sold. Alright, so that's the meaning of minus. Alright, so it will be subtracted. So one treatment will be recorded in the profit and loss account by subtracting when we are estimating cost of goods sold. Alright. And Next treatment will be balance sheet. Alright? In balance sheet, we record as a current assets. Alright? Because in the first video, you have seen what are the items involved in the assets. Alright? Current assets, non-current assets. In current asset, we have cash, we have accounts receivable, we have prepaid expense, and closing inventory. Alright? So right down here is a current assets. Current assets. Alright? So that's the ideas behind the treatment of the closing stock. Alright? Now move on to the second one. Second one is outstanding expense. Outstanding expense. What is outstanding expense? Outstanding expense is any kinds of expense that we which is due but we haven't paid. Alright, I repeat, outstanding expense is any kinds of expense which is due but we haven't paid it, such as electricity bill. Alright, electricity bill is a due but we haven't paid it. Alright, so what will be the journal entry for outstanding electricity bills? Alright, so let's say that outstanding electricity bill is $100. So transaction will be, journal entry will be debit electricity bill. Alright, credit outstanding electricity bill. Electricity bills, debit or debit electricity bills account, and credit outstanding electricity bills account. Alright? So what will be the treatment for, how we records in our company accounts, where we records? By looking at journal entry, you can also make your judgment that how you're gonna records in your profit and loss accounts and in your balance sheet. Alright? So you can see that debit electricity bills. So electricity bills is expense, expense is debit. So of course it will record it as an expense in your income statement, in your profit and loss accounts. Alright? So profit and loss account as an expense. So it will record it as an expense in your profit and loss account. Alright? And in your balance sheet, it will be treated as a current liability. Alright? Maybe last time I forgot to explain you outstanding bills. So keeping in mind, outstanding bill is your current liability. Why? Because you have obligations to pay, and the due date if you haven't paid electricity bills, is you get already missed it, and then electricity boards or government, they're not going to give you too much time to give you electricity bills. So they're going to after maybe 1 week or 2 weeks later, they're going to add the penalty to in your electricity bill. So you want to pay off as early as possible. All right, you don't want to wait it or keep it too long, because if you're keeping it too long, penalty is keep increasing, keep increasing, and at the end, government will cut your electricity. All right, so by that reason, you would like to pay as soon as possible. That's why it's treated as a current liability. All right, obligation to pay in short period of time. All right, so by that reason, it's treated as a current liability in your balance sheet. So remember, outstanding expense, no matter it's electricity bills, it's rent, it's interest, or it's a wages, salary, no matter what kind of expense is it, but it treated as a current liability if it's outstanding. All right, which means you haven't paid it. Right? Next, third. Next is a prepaid expense. Now, what is prepaid expense? Prepaid expense is any kinds of expense that you expense you have paid in advance, prepaid. All right, prepaid expense you paid in advance, such as your rent. You're supposed to pay rent 1 month in advance, but you paid 2 months. All right, so that treated as a rent, prepaid rent, right? Because the rent you paid in advance. So what will be the journal entry for this prepaid expense, which is rent, for example? So debit prepaid rent and credit rent account. So it's all account. So debit prepaid rent account and credit rent account. Okay. Now, what will be the treatment for your profit and loss account in the balance sheet? In your profit and loss account, it will be subtracted from your rent because you already paid rent in advance. So, of course, next time you don't have to pay. All right? So, minus from you don't have rent, any kinds of rent in your income statement, then you minus from your cost because it will reduce. Right? And in your balance sheet, of course, it is your current assets. Remember, you have a look your running outcome one in your current assets, cash, account receivable, closing inventory, and prepaid expense. All right. So that's kind of item will be treated like this. All right. Now move on to the number 4. Next one is accrued interest. Accrued income, sorry. Accrued income. Now, what does it mean, accrued income? Accrued income means any kinds of income that you earn but you haven't received. The income that you earn but haven't received, that's called accrued income. All right. So what will be the treatment for accrued income, accrued interest? All right. So your journal entry is, so let's say is your interest. All right. Your interest that you earn it but you haven't received. So debit So debit, accrued interest, right? Credit, interest, right? So it will be, of course, will be part of your profit and loss accounts. You can, it's an income, all right? If it's an income, then of course it's going to maximize your revenue or minimize the cost, all right? So revenue or cost. Is going to maximize your revenue or minimize the cost, right? Next is so another impact will be on the balance sheet. It will be treated as a current assets, all right? Because you have a right to receive, all right? So that's called accrued income. So accrued income means, I forgot to mention, we earn but not received. We haven't received it. All right, so that's called the accrued income. All right, now move on to the next, number 5. So number 5 is income received in advance. Income received in advance. So as you can see the name, any kind of income that you received in advance. All right, or you can say that any kinds of unearned income, unearned, because you haven't earned it, you just receive it, receive in advance. All right, so what could be income that you received in advance? Could be for example, you invested money, one company, you are a company and you invested money in another company, you bought a share and you receive a dividend in advance. So means that's your income that you received in advance. All right, so so as you can see, any kinds of income that you receive in advance, we also call it unearned income. Unearned income, right? So journal entry would be for this one is a dividend income. All right. Debit dividend income and credit dividend income received in advance. Right? Dividend income received in advance. All right? Dividend income, debit, and credit dividend income received in advance. That will be the journal entry. Now, what will be the impact on your profit and loss account and a balance sheet? The profit and loss accounts, it will be treated as an expense, right? Or it can be subtracted from, it could be added to any kinds of dividend, right? So you can minus from sales. Alright, and in balance sheet it will be treated as a current liability, right? Because you haven't earned it, right? So you have to earn it. So you have obligations to perform the duty. All right. So that's called the income received in advance. Next, number 6 is a depreciation. All right. You know that, but if you do not remember, I will repeat here again. So what is depreciation? Depreciation means they depreciate the value of the assets over the period of time, and of course fixed assets. All right. Reduce the value of assets over the period. Right? So that's called depreciation. So what will be the treatment? You know that. Debit, depreciation. Right? Credit, whatever is the assets. So let's say car, vehicles. Right? So what will be the adjustments in your profit and loss accounts? Treat it as an expense, right? And in your balance sheet, subtract from vehicles, because vehicle is your current fixed assets. All right, so in your fixed assets you have vehicles, and then you're going to subtract this amounts from your vehicles. All right. Now move on to number 7. Number 7 is bad debts. Bad debts means any kinds of accounts payable who is unable to pay you on due date. Right? Any kinds of account, any kinds of customer accounts receivable who is unable to pay you on due date. All right. So accounts receivable unable to pay on due date. So when time to pay, they say that, oh, sorry, we don't have money, all right, or they bankrupt on the due date of receiving money, or buy them to pay to you, all right. So what will be the journal entry? That you also know that, all right. So debit, bad debts. Right? Credit, accounts, receivable account. Right? And the treatment will be profit and loss accounts. It will be treated as an expense. Right? And in balance sheet, subtract from accounts receivable. Of course, accounts receivable are going to reduce. All right? So that's why we will minus from accounts receivable. All right? So keeping in mind, another name of account receivable is debtors. All right? Account receivable is called debtors. accounts payable, we also call it creditors. All right. Now move on to number 8. Number 8 is a provision for doubtful debts. Now, what does it mean, provision for doubtful debts? Every year in our business, let's assume 5 to 10% account receivable do not pay us money. So they bankrupt, so they don't pay us. So it means every year 5 to 10% amount of debtors or amount of account receivable become bad debts. Alright, so that's why this year when we are preparing our accounts, we will make up provisions on the basis of the previous facts. That we're gonna make a provision that maybe this year our account receivable, 5% account receivable, they're not gonna give us money. So that's called the provision for doubtful debts. Doubtful means any kinds of account receivable on which we have doubt that they may not pay us money this year. So we're gonna make a provision. So which means in accounting, it says that future income is not the present income, but future expense will be present expense. All right. So on the basis of this concept, we're going to make these adjustments in our final accounts. All right. So I repeat again, what is the provision for doubtful debts? On the basis of the previous facts, we assume that, or we have a doubt that this year some amount of account receivable, they're not going to return money back to us. All right, we have a doubt on it. So by that, on the basis of that doubt, we're going to make up provisions. All right. So what will be the journal entry? Journal entry will be profit and loss account debit profit and loss accounts, and credit provision for doubtful debts or provision for bad debts. Doubtful debts or bad debts. Debit profit and loss accounts and credit provision for doubtful debts. So the general the treatment will be in our profit and loss accounts. It will be treated expense. It will be treated as an expense, and in our balance sheet, it will minus or subtract from accounts receivable. All right. So keep in your mind, If we have bad debts and we also have provision for bad debts, then we will subtract bad debt first and then we subtract provision for doubtful debts or provision for bad debts. So let's say in our balance sheet, if we have account receivable, we will subtract bad debts first and then we subtract provision for doubtful debts. And then that's the final number we record as an account receivable in our current assets. Alright? So that's the treatment for provision for doubtful debts. Now move on to the last adjustment like this. Yep, it's a last one, which is a provision for discounts on debtors or discounts on account receivable. Provision for discounts on debtors or account receivable, because debtors means account receivable. So what does it mean, provision for discount on account receivable? So which means we make a provision that we will give discounts to our account receivable in order to receive money fast, or receive money earlier than the due date. Alright, so let's say we're supposed to receive money after 3 months, but we may need money before 3 months, some other investment opportunities or some other purpose. So that's why we will give discounts to our account receivable in order to receive money earlier or receive money faster. Alright, so but it's a provisions. Alright, so that may happen or may not happen. We're gonna make a provisions, right? Because again, it's the same ideas that provision is your expense because you're gonna lose the value of account receivable, but it's maybe in future. Alright? So maybe in future you receive you reduce the value of account receivable because it will treat it's a discount. It's a losing the value. Alright? So means future expense is a present expense. So that's why may I receive money in the future, but right now I'm going to treat as an expense, a provision, all right, for giving discounts to account receivable, all right. So the journal entry will be journal entry will be debit, profit and loss accounts, credit, provision for discounts on debtors or accounts receivable. So the treatment will be in your profit and loss accounts. It will treat it as an expense. And in your balance sheet, it will minus for accounts receivable. Again, we subtract bad debts first, then provision for bad debts, and then the third one is the provision for discounts. Alright, so that's also that's the treatment for provision for discounts on account receivable. All right. So that's all about your learning outcome 2 complete, which is final accounts with adjustments. We have 9 adjustments. All right. So in your assignments, you have to in your assignments, I'm going to give you some kinds of these adjustments. I'm going to give you trial balance, and next to the trial balance, I'm going to give you some adjustment, 9, 10, 15, depends. And then you're going to use that adjustments to complete your final accounts. All right. So later I will mention in my outline whether you can add adjustment as a task 3 and final account with adjustment task 4, or you can combine task 3 and task 4. So you can see the outline that I will send you soon. And of course, in the next session or in the live session, so I may give you more guidance over your assignment. So hopefully today you will receive. Today is it's 24. So today 24, you will to 24, 25, you're gonna receive your assignments, and then you start working, and then make sure you finish the questions that I gave you in the first video. Questions, that is a simple, so you have, until trial balance, you have to make journal entries, ledger, and trial balance. All right. So means that's questions about your learning outcome 1. All right. And in the next session, live session, I will discuss about your assignments. I will explain you how to do your assignments, and then of course I'll give you some guidance, not the solution. Of course, I'll give you guidance for your assignments with some outline. All right. So we keep look back what we studied in today's. So we studied about what is the adjustments means, all right, and the difference between simple final accounts and final account with adjustments. Of course, adjustment, we have to make some changes or add some additional informations in order to complete your final accounts. Why we do that? Because if we will not adjust our transactions, that information may be incomplete or unfair for the users. All right. In order to provide true and fair information, we have to make adjustment. All right. Second thing is that you have to understand what is the meaning of accrual base, which means any kinds of income that we earn but not receive on the basis of earning, we record, not on the basis of receiving. So initial transaction, initial recording will be based upon the earning. Similarly, in expense, initial recording will be based upon the incurred, not on the based on the paid. Right? And then we look at the various transaction with journal entries and their records. Right? So that's all about your learning outcome 2. So learning outcome 1 and learning outcome 2 finish. So which means the informations for your assignment 1 is finished. So in next session, I'll see you with discussion the outline and the assignments. All right. So I'll see you. Thank you.